My script says it's 12 o'clock.
It was at one point in time.
It was
sometime.
Really
Yeah.
good.
Feel free to set your clocks. And I'd like to call the meeting of the OPEB Retirement Trust Investment Board of Thursday, October 23rd, 2025 to order. Before we begin, please note this meeting is being recorded. Welcome to everyone joining us here in person, as well as those listening in on the phone. If you would like to provide public comment at today's meeting, and if you have not done so already, please let the district secretary know what items you would like to speak on today, or speak up if we're calling on you. Madam Secretary, please begin by calling the roll.
Thank you, Director Cochran.
Here.
Devlin.
Here.
Giudice.
Here.
Hernandez.
Here.
Maston.
Here.
Verdoni.
Here.
Vice Chair Parr.
Present.
Chair Rabbit is absent. And we have an ex officio of Jennifer Minucci.
And we also have
Also in the room, we
Director
have
Hill.
Director Hill, and we also have Director Snyder as the visiting directors here. But we also have Andrew Brown in the room. He's at the end of the table. Allison is also here. We also have Cody Smith over there on the right-hand side, and to the left, that's Grant Martinez.
Welcome, everyone.
Hey, Kim.
Kim.
And Kim. And Dennis is here.
We just assume you're going to make it. Okay. Please follow along by referring to the page numbers located on the top right-hand corner of your meeting packet, or the page numbers found in the attachments. We'll begin with item number 3, which is to approve the consent calendar. Before we take our votes, are there any questions from directors on the consent calendar? Okay. That concludes the discussion on item number 3. Before we take our vote now, is there anyone from the public wishing to speak to the group?
We have no speakers on the public line or.
Thank you. In that case, may I have a motion on agenda item number 3?
Second.
Thank you. Madam Secretary, please do a roll call vote.
Thank you, Director Cochran.
Yes.
Devlin.
Aye.
Giudice.
Yes.
Hernandez.
Yes.
Maston.
Yes.
Verdoni.
Yes.
Vice Chair Parr.
Yes.
Chair Rabbit's absent. And 1, 2, 3, 4, 5, 6, 7. So our votes are 7 there. So you have that passes.
All right. That's it, Lisa. To get things really organized. We'll now continue with item number 4, which is the OPEB Retirement Investment Trust Board Education. You're the teacher, Andrew. Andrew Brown of PFM Assessment Management is here to present the report. Andrew, please proceed.
Thank you, Chair Parr. And as you said, it's 12 o'clock, so it's good afternoon. And I'm here to give you an update. And I understand that you've had a jam-packed day up to now. And so I am coachable, and I've been coached to make it maybe a bit briefer than previous updates have yielded. And so I'm going to streamline it. The agenda that I've laid out on page, I think it's page 1. If you're okay with it, the economic market moving events, my colleague Monique passed her in the hallway, and I understand maybe she checked that box for me today. So I'm going to maybe start on item number 2, the International Equity Review, hit a couple topical points there, and then look at the Blue Vista Real Estate Partners Fund, a new fund that we've onboarded recently over the last couple of weeks. And I think the International Equity Review, and I'm looking at the page numbers in the bottom right-hand corner. I'm going to say it starts on page 11. And page 11 should show a table.
Give us just a moment.
You bet.
We're balancing salads and. Okay. Look up if you found it. Thank you, Andrew.
Okay. So starting on page 11, and really over the last, maybe 4 or 5 months, that's the one. You bet. One of the items that's been coming up in my meetings is, wow, international equities has really done well. And so international equities is defined by PFMA, our main benchmark, if you will be that first row under the international equity header. They're sort of at the upper third of the page. And the primary benchmark that we go up against when we manage the OPEB plan assets is the MSCI ACWI ex-US Net Index. And if you scroll over to the far right-hand column, you see annualized rate of return for the last 5 years has been 10.09%. So 10.09%, when we do our capital market assumptions, we think international equity should get us about 6.9%. So expect 6.9, get 10. It's been a pretty decent period of time for the last 5-year annualized rate of return. But as clients are quick to point out, well, why don't you go to the top row, Andrew, and tell us what the S&P 500 yield over the last 5 years annualized. And that's, of course, 16.5%. So 10 is less than 16.5%. So yeah, it's been slightly disappointing if you compare international equities to domestic equities. But to make the point today, what I tried to do in the middle of the page under that year-to-date column is show some of the international equity benchmarks, and I bolded it since we're not on a Zoom call and I can't run the cursor over it. But just look at that same underlying benchmark. ACWI ex-US up 17.9% year-to-date for the first 6 months of this year. So that captures Jan 1 to June 30. And then compared to the S&P 500, that's up 6.2, not too shabby, but once again, not 17.9. International is about three times the rate of return over the first 6 months. So clients are saying, well, what's going on? So I thought it might be worthwhile just to take a look at maybe what's driving some of these returns. So if you could turn to page 12, and I'm going to, I would say when I first had to answer this question, I did the knee-jerk reaction. Oh, it's all currency. And it's a lot of currency, right? Because international equities are going to be denominated in the foreign currency. And to the extent that the dollar goes down, the foreign currency goes up, well, we get a little bit of a tailwind in terms of return. And for the first 6 months of the year, the U.S. dollar index down 10.4%. If you ask me, well, what has it been since, June 30th? It's still roughly about the same category. The dollar's down about 8.5%. So much of this is currency. And if you look at page 13, you can see that in some markets, it's really impactful. I'm just going to focus maybe on the far left-hand part of this page, where we compare in the dark blue. If you're a European investor investing in your local currency, for the first 6 months of this year, your overall generic index generated a 10.8% rate of return for 6 months. I mean, that's a great rate of return for 6 months. But if you're a dollar-based investor, look at the light blue column next to it, 25.6%, almost 2x, right? So yeah, a lot of this is currency. But if it was just currency, then we might be a little bit bashful in terms of maintaining 19-20% of plan assets allocated to international equities. If you could turn the page to page 14, and I'll give credit, even though I don't give credit on the page here. I heard a presentation from JP Morgan maybe mid-July, and they created a slide similar to this, and we recreated our slide based on their work. So I'll give a little bit of nod to JP Morgan. And what they did was they looked at 6 or 7 topical global investment themes over a recent 3-year period of time. And so each one of these themes is represented by one of the color codings there with the line charts on this page. And in the grid to the left-hand side of this page, the first item maybe in like purple, dark purple, is the Russell 1000 growth. And so we're going to use the Russell 1000 growth as maybe a proxy for, and it's a very good proxy for a lot of those growth-oriented Mag 7 stocks that have really been propelling our returns over the last 3 years. So here we have Apple and Amazon, Microsoft, Meta, Google, NVIDIA. Right? So these are the big names that have generated a lot of our returns domestically. So that's the dark purple line item. And so might we expect that to be the leading category over the last 3 years? We might, but it's not. The yellow category that is noted here, MSCI Europe Aerospace and Defense. So European Aerospace and Defense. Well, what might be driving that? Well, Boeing's woes are recent woes is probably Europe's benefit, but yeah, think about President Trump's encouragement of NATO to spend a little bit more for their own defense. That's a catalyst. But also think about what we around the office maybe informally and maybe inappropriately call the Zelensky treatment, right? Back in February where President Zelensky came over from Ukraine and got hotboxed in between President Trump and Vice President Vance. That wasn't lost on European leaders. And maybe the lesson to some of the European leaders were, we really do probably want to think about spending more on our own defense. And, just kind of look where that yellow line starts to take off, the end of February. So there are international equity categories, and it's not just currency. Other categories that have done well. The blue is European and Asian financials. That has also been a strong category. The orange is MSCI Taiwan infrastructure and technology. That probably has some dovetails with our growth sector. But even the Indian consumer is pretty much in lockstep with what we've been able to generate with our large cap growth stock. So I wanted to say and present to the committee that this little educational tidbit, it's more than just currency, but it's a lot related to currency. Last time I presented a new fund. We onboarded the Blackstone Global Infrastructure Fund. And I thought it might be worthwhile to spend a little bit of time on talking about the private real estate fund that we just recently initiated a position in. It is called the Blue Vista Real Estate Partners 6 Fund. And just want to hit a couple of highlights on this fund. Currently, we have roughly about $750,000 of an investment in the fund, earmarked for about a 2.2 million eventual investment. So it comes out to be about 1.5% of plan assets. In terms of private real estate, the things I would have you focus on at the top of the page, you're investing in a private real estate portfolio of properties or loans. Usually it's properties. So these are not REITs. They're not publicly traded. So because they're private, it's going to be less liquid, or, I'm probably being gracious there. It's going to be very illiquid. The advantages, it can be a solid hedge against inflation. Certainly it has a lower correlation with equities, and equities are 55% of our portfolio. So we want other asset classes that contribute to diversification, lowering the volatility. They do have a lower volatility if you compare them to publicly traded real estate stocks, and it gives you the ability to diversify amongst a variety of sectors and geographies across the United States. Of course, there's also some disadvantages. They're less liquid than REITs, certainly. Smooth volatility due to less frequent valuations. And I should probably explain that, because sometimes smooth volatility might seem like a good thing. But sometimes there's just a dearth of valuations that you can really point to mark to market certain prices. So it may seem like the underlying asset hasn't really suffered a price decline, but that might be just because there's less valuation. So it is actually a disadvantage there. Less transparency with private real estate, or really with any private investment. And then finally, higher fees. Got to address that. The fund that we're invested in has a 1.5% stated investment fee, so much higher than what you'd see from a real estate fund. If you can turn to the next page, the burning question probably on your mind: why real estate? Why now? I know you're all waiting, so I will say that the main factor is going to be price. The second factor is going to be rates. Interest rates, from our standpoint, are likely to be 2 more rate cuts this year, 2 to 3 cuts next year. That should give a little bit of a nice tailwind to real estate, as well as some other sectors out there. So certainly have to acknowledge our anticipation that interest rates are going to be coming down over the next, call it 15 months and maybe longer. But price, right? I mean, you want to buy low and sell high. And in the upper right-hand corner of this presentation, we copy an exhibit that PGIM came up with, and that's the old Prudential Group firm. And what PGIM did in the upper right-hand corner is they compared peak to trough declines over 4 property sectors, and then an overall sort of property index. And that's they compared the great financial crisis declines, and that's going to be the light blue. And then they compared the current market environment in the darker blue shaded column. And you can kind of see both on an office as well as industrial, and it may be very noticeable on an office. The declines that we've seen over this cycle have slightly exceeded what we saw in the great financial crisis. So in terms of trying to find something that has had a decline in price, certainly private real estate would check that box. And at the bottom of the page, there's another exhibit from a different firm, Green Street, that puts out some real estate analysis. And in that orange shaded region, it's labeled an attractive entry window. And we do think it's an attractive entry window, but I don't want to give anybody on the board the thought that we're calling the bottom, that we can get the lowest price out there. I mean, it's going to be a process. But that's one of the nice things about private investment. You invest, the investment manager takes over, a methodical period of time and looks to be judicious in terms of adding the exposure to real estate. So we hope that that's an advantage. Yes, sir.
Excuse me, what's GFC?
A great financial crisis.
Oh.
So what we saw from 2007 to 2009.
Great, thank you.
So price as well as rates. And then finally on the last page there, just a couple of quick hits on the investment characteristics of the fund. It's shepherded by Blue Vista. This is their sixth fund, so they've had 5 other funds. Seasoned team out of Chicago, been in business since 2002. Market capitalization since inception for real estate about a little bit under $15 billion. So certainly they're well experienced. The fund itself isn't going to be huge. It's probably going to be a little bit less than $1 billion in assets once it gets fully subscribed to. And with that, maybe targeting 60 to 75 investments, and you do some quick math, $10 to $75 million, or 2 to 15, I should say, for the individual investments. Maybe the main stat I should have probably led with is the targeted IRR, 13 to 15%. So that 13 to 15% probably indicative of, if you go to the bottom of the page, you can see that the differential between acquisition and development. Development's 20% of their projected expenditures. Then the acquisition is 80. And the acquisition is, hey, we see this great property over here. It's already built. We're going to buy it, spruce it up, release it, get more people in there, and flip it. And so it's a little bit less risky than saying, hey, you see this raw piece of land over here? We want to build a new building here, try to get tenants to come in and hopefully then flip it at a later date. More risk associated with the development side, and it's not the bulk of what they do. But it should, if they do everything right, it should add to that incremental couple percentage of gain. So we're excited about it and look for good things from the private real estate. Yes.
Can you share with us more details on what defines a niche property?
Yeah, niche property. So if you look at the property descriptions there in the middle of the page, the ones that are there maybe more more legibly or understood, industrial, residential, and then self-storage. These should be more like what you would see from like college dormitories. So one of the burgeoning areas within real estate would be college dormitories. You spruce it up because every college is kind of competing with each other for new students. And my daughter went to the University of Alabama. And the first time I walked into her dorm, I thought, oh, Beverly Hills 90210. No, Melrose Place, the other one that dates in, right? I mean, it just looked like Melrose Place. It was awesome. So that's one niche category. You can have some specialty industrial data centers. Some people define data centers as a niche type of properties.
Thank you. Other questions? You want him to start over on anything?
Did I go over my time? Sure.
Absolutely not. We like to hear from you. You're a lifeblood, I think, aren't you? All right. Number 3?
We're at number 4. We have no speakers. We have no public speakers on the line or on the side.
The script. Oh, there it is. Remember. All right. So now we're on number 4. Number 5. Thank you, Andrew. We hope you got to have a little lunch. No actions needed for number 4. Number 5 is the OPEB Trust Investment Advisors Investment Performances Report for the quarter ending June 30th, 2025. And Andrew, that's yours again.
Great. If I could have you turn to page 2.4. 2.4, the page number should be in the bottom right-hand corner. And once again, I'll kind of wait till I see heads bob up.
Do you see the whites of our eyes?
That's the one. So on page 2.4, and I'll just maybe focus on most of my discussions on the first two rows at the top of the page. Total fund, and the calendar periods are depicted at the top of the page as you go from left to right. Quarter, which is going to be April 1st to June 30th. Fiscal year to date, 1 year, same period of time. Then you have 3, 5, 7, 10 year, and since inception period of time. And really, I would say 8 out of 10 times, I could show you a 3-month period of time where we generate 6.47% and a fiscal year return where I get you 11.5%. Not only do I get lunch, I'd probably get a cookie too. But this might be one of the times where I get the fruit cup and no cookie. But I prefer fruit, truth be told. And what I said is,
You should check the bottom. There's a cookie on the bottom.
just like the cereal box.
Uh-huh.
Thank you. And so why is 6.47 disappointing? Well, it's disappointing because the benchmark was 6.91%. So that's, 44 basis points of underperformance. And when you look at the fiscal year return, it was a 59 basis point underperformance. So really the last quarter of the year really explains most of the underperformance for the fiscal year. So we have to address that. Most of the underperformance for the last quarter would really be laid at the doorstep of our underweight to equities. And I just went through some of the equity returns. And so you saw, even though it goes a little bit against logic, why international equities would do so good when tariffs are being applied to them, and why would our domestic equity market do so well when the same sort of disruptive policies are being implemented. We saw that, and we saw the risks prevalent in the market, or at least we interpreted the risks prevalent in the market, and we moved to an underweight position to equities. And so if our neutral position would be 55% for the OPEB plan, we were probably at 52% for, call it, 10 of the 12 weeks of that quarter. And if we were underweight equities, we were overweight fixed income, and fixed income generated 1%. And the S&P was up 11. So that explains the bulk of the underperformance. The other part of the underperformance certainly would be also pointed to one of our international managers, the Goldman Sachs GQG fund, which generated a 7% rate of return, but the benchmark was at 12. So there was a bit of a headwind there. Put that together, and that's the disappointing story of the most recent quarter, to the extent that 6.47 for a 3-month period of time is disappointing. And then on top of it, as Alice mentioned, and I didn't need to be reminded, CalPERS was ahead of us too over the last 12 months. So piling on. But those would be the main points I would want to communicate with you. As a follow-up to the underweight to equity point, I do want to share with the committee that in the second week of July, we moved back to a neutral allocation to equities, so back to 55%. The catalyst there being the One Big Beautiful Bill, Budget Reconciliation Act, that was passed on July 4th. It's going to be a huge catalyst for corporations, and also many of us at the table in March, April, May of next year might see some nice refund checks coming our way that possibly we will spend. So that was the differential catalyst that compelled us to go back to neutral. But did leave a little mark, if you will.
Smiling because I'm about to tell a joke that's inappropriate.
The recorded call.
No.
I'm from Iowa. We're kind of doubting Thomases on occasion. And when you talk about us getting a big refund check next year, I'm tempted to say, really, how's that going to work for you? You think that's really going to happen?
See, I've heard that. That's why I prefaced it by saying some. some. And that didn't convince you.
If you get one, let us know. Anyway, thank you, Andrew.
You bet. And I have some other pages. I know you've seen this in advance, but that was maybe the main message I wanted to give you, just given the abbreviated presentation.
Are there any questions or comments for Andrew on this part? Anyone from the public?
We have no speakers on this
Anywhere? No?
from anywhere.
All right. So Alice, I think you're next.
We need a motion.
Oh, we need a motion to receive.
So move. Second.
Would you call the roll, please?
Got it. Cochran,
Yes.
Devlin,
Aye.
Giudice,
Yes.
Hernandez,
Aye.
Bordoni, Chair Parr,
Aye.
Chair Rabbit's absent, and you have 7, so vote unanimous.
All right.
Those present.
Thank you very much. Now we'll continue to item number 6, which is the review of governmental accounting standards, board number 75, accounting and fiscal reporting for post-employment benefits other than pensions, actuarial report for fiscal year ending June 30th, 2025. Alice Ng is here to present this report.
Thank you. Yes, this report, this item is our GASB 75 report, and this is what is used in our CAFR to record our OPEB liability at the end of fiscal year 6/30/25. For this year's valuation for GASB 75, we're using the 7/1/23 valuation, and based on the actual trust activity and the total covered payroll for 23, 24, and 24/5 is how we get to the OPEB liability for the valuation. So if you turn to the second page, you'll see a graph that looks kind of like this here. So this is what's going to show up in our AFR. So we'll have the total liability at the end of 6/30/25 of $194.2 million. And that's a $3.6 million increase from last fiscal year of $190.6. The next line is the fiduciary net position. That's just a fancy way of saying that's the market value of our assets. So we're pleased to say that as of 6/30/25, our assets have increased to $142.1 million, which is $14 million higher than what it was a year ago at $128.1 million. Therefore, the net OPEB liability, or net liability, is a difference between the two. So it's going to be $52.1 million at 6/30/25, which is $10.4 million decrease from last year's 62.5. And you'll see that our funded status has improved to 73.2%, which is very nice. The one other notable thing I want to point out is because we're fairly well funded here, we passed what they call the, carryover test, where at no time during the valuation period does the fund run out of money. So there's enough assets to pay for every individual till their passing. So therefore, we're able to use the discount rate of the 6.75% of the plan, and we don't have to use a blended rate, which includes a municipal bond rate, which is like 4%. Why that's notable is because if we had to use a weighted blended rate, it would be lower, and therefore the liability would have been higher. And so some of you might have seen that in perhaps another plan, but I want to just make note of that for everyone.
Would you say that again, that we have enough money there to pay all of our liabilities? Because it doesn't feel that way.
For OPEB liability.
Liability, right?
Yeah. They do have what they call a crossover test, so the actuary will actually forecast out to the end of the plan based on the census of that valuation. And because we fund the plan every year of the actual determined contribution ADC, and thanks to Andrew and his team getting good investments, there's sufficient assets to pay for based on every actual assumption that's done.
Assuming everyone quit at the same time.
No. If everything goes exactly to what the actual assumptions were, but who dies when, and all that kind of stuff.
Yeah, the part we want to show that improve the actuarial runoff.
And the last thing I want to point out, so I mentioned that we used the 7/123 valuation. We are doing a new valuation, which is as of 7/125. So we'll have a new census and a new liability after that. And that will give us the ADC for fiscal year 26, 27, and 27, 28. And I think we're working with the actuary now. So I'm anticipating that we'll have the valuation probably November-ish. So at the next trust board meeting in March, we'll be able to present it to you all.
Thank you.
Alice, it seems that each year they come back and our liability keeps rising, that's all right. My question probably goes to Andrew. We're doing, I think, an excellent job on our OPEB funding, our liability. What are other agencies doing? Are they matching what we're doing? Are they above us, below us? Where?
Yeah, I think that the first thing that popped into my mind is some aren't taking reimbursements. And so for those agencies that aren't taking reimbursements, maybe there's a little bit more of a tailwind. 72% is above what I would say average. But then you get into like what I would say like water districts. Water districts, it's not fair. And 100% plus. But in terms of doing what you, and I hate to say this, doing what you should do, because lecture, I think you're doing a great job.
Well, I noticed the county that I came from, a small county, they have done little or nothing toward the OPEB, so their liability is bigger. So if we didn't do this, the liability is there. I mean, that's
because then the actuary, Foster and Foster wouldn't give you 6 3/4. They would give you the 20-year municipal rate of I think 3.6. And if your discount rate is that low, your liabilities get totally jacked.
okay.
I would add that I'll talk about it more at the next item, but realistically, there's 3 main things that you must do, right, to manage a good plan. You got to first always put in the required contribution, which this is what we do as a policy. 2 is control expenses, the money leaving the plan. So we've done that several times we did the HRA many years ago, and then we did the whole CalPERS transition to the health plan. So that helped us. And thirdly is to have a good partner as an investment manager. I think those are the really 3 main things. If you do that, I think in general, you'll be okay.
You're instilling great confidence. Seriously. It's always nice to hear that. Are there other questions? Those are great questions. Were there other questions for either Alice or Andrew? All right. With that, there's no action required on this one. We'll continue to item number 7. Thank you, by the way. So thank you, Alice, for that insight into how we sit with the plan. There's no action associated with item number 6. We're going to continue to item number 7. Right one?
Yeah.
Which is to conduct an annual review of the OPEB investment policy, trust board service providers, and the trust board charter, and authorize submission of the trust board's annual report to the district board of directors. Alice, I believe this one's also yours.
Yes. So this is our annual review. We do this every year in our October meeting. And based on the charter, we are required to do things, or the board is required to do things. One is to review the OPEB's investment policy statement, or the IPS, the trust board service providers, and also reassess the trust board charter to see if there's any changes that you'd like to make. And therefore, you'll see these binders that on near you. So they house those 3 policies. So you're free to look through them. And then finally, based on this discussion, the board then can review the drafted annual report from the trust board to the district board, and that's attached, and we can go through that at the end. The first thing that I wanted to do, and because it's a good leeway to what we just discussed, is on the second page, on the top, you'll see a table. So this goes to what we were just talking about before that. It's really just those 3 things: the contribution, the payments going out, and the investment return. So what you see is what I call basically a roll forward. It starts with the beginning balance of every year. the district has put in terms of contributions, the payments going out, and then investment returns at the ending balance. So you can see through every year since we implemented the trust in 0708, you can see how the plan or how the trust has grown to over 148 million at the end of 6/30. So you can see through this period, the district has put in over $218 million in contribution. We paid out $170 million in benefits and expenses, and the investment returns have brought in close to $95 million. So that's the magic of pre-funding, right? Because you wouldn't have any extra $95 million to be used to pay for the benefits.
In addition to my other question, then, so to me, in possibly 5 years, we'll not have to make any contribution at all.
Well, only if theoretically your ADC is comprised of two things, right? So it's your normal cost is what all of your current employees earn for. Then also there's that unfunded liability. So if we hit every assumption that the actuary has made, including the 6.75%, if everyone passes away that they think that they're supposed to, everything is, and more importantly, the increase in healthcare is what they use in the assumptions, which is always the one that's off. You're right. At one point you'll be completely funded, but the fact in reality is that unfunded liability is always changing, right?
Right.
Always changing. But what we did, I don't know if you recall, maybe a couple of years ago, and you kind of can see this in this graph. You'll see that in the annual contribution. You'll see in 22, 23, and 2024 how the ADC dramatically decreases from 12 to 8 million. Well, that was because if you look 2 years ahead of it, there was an investment return over almost 26 million in fiscal year 2021. And so because we had such a great investment return, and you're well funded, it reduces your need for your ADC. Now, when the actuary first presented this, they came out with ADC much lower than 8.1. And Joe and I talked, and we said, the district can't really adjust to these, values and, going up and down.
Can't keep chasing it.
Exactly. So we talked to the actuary, and we wanted them to start smoothing out some of the gains, as well as starting to add layers. What I mean by layers is that, usually evaluation will have a 30-year closed model. To your first 30 year, you only have 4 or 5 years left. If there's big noise, you got to amortize it in just that 4 or 5 years. So it's big leaps, right? Changes. So we're amortizing a little further on those as well.
But it went down several $1 million, which is very beneficial.
Yeah. Oh, yeah.
And if you look, how much was paid out, if we had adopted the pay-go model like some counties have, then we'd be putting more in than we did those in 22, 23, and 23, 24, because what was paid out exceeds what we put in. And so, pre-funding is the key.
Right.
And sound management of the plan.
So I have a naive question. Do we ever want it to be fully funded so that
So theoretically, I think that if it's a way to tell,
I noticed that Jennifer's looking at Alice. Dennis just whispered in my ear, so we'll just take whatever you give us.
Well, I was just saying that, typically even with pensions, you don't really need to be 100%, right? You want to be like between 80 and 90, because if you're 100% funded, then you're really using resources of the district that could probably be used for something that we really need, right? So as long as you're adequately funded, because these are long-term liabilities, these are 30 years out. So as long as you're adequately funded, 80% has been touted with, the pension requirement of that. If you're 80% funded, you're in the green zone. So I kind of use that as a.
Will you keep reminding us that every time we meet? Seriously, because it's a major negotiations item over and over and over.
It's a lot like pension, right? I mean, I get a lot of employees that are like, I can't retire. I need to be at 100%.
Yes.
I remind them, you're not living off of 100%. So you've got all these taxes that are getting taken out. I said, so when you retire, you don't have some of those taxes that you have going towards your pension and going towards some of these other places. So to me, it's kind of the same thing here. The actuarials, it assumes what your employee base is now, right? Not everybody retires from us. Not everybody is going to live at the same way the actuarial was. So you want to smooth it out. When I first started here and we were just paying as we go for pension, it was like 0. And then it was like 2%. And then it was like 25%. And I was like, whoa, we can't do that. And we had to really get with CalPERS and other cities at the time because the .com bubble was going on, right? That they were like, oh, our investments are great. You don't have to give us anything this year. And we're like, we internally, you have to smooth this because when the bottom drops, which it did in 2002, you don't have anything in the reserves to kind of balance out that new chain. So I think that's the same thing here. Is you're trying to, as Alice says, it's always the long game. Lucky for us, we have enough in the fund now to kind of play with that. If you're underfunded, you're always catching up. Some of you guys are working on one of those pension boards where it's you can't catch up with nothing. You can't make money with nothing, and you can't be flexible with the changes either in the investments or your employee base. So I think that's always been important for us to look at kind of a long projection as opposed to, oh, we did great last year. We don't have to put that much in. We do that obviously with our capital projects too. So I think that's the same mantra to keep us solvent. But Alice is right. You don't want to overfund it because then I'd be like, oh, we could have used that money for.
Well, I appreciate that attitude, and I would hope, I'm not going to be here forever, but some of you will be here forever. And I hope that you adhere to that. That you don't have to overfund, but make sure you don't underfund.
That's exactly right.
Some of us sat through the times that were awful.
Yep.
When that was the only topic of discussion. And then we'd send people like Chris and Jim to figure it all out.
And then
Right.
And what's nice though, because we do the valuation every 2 years, the ADC is always changing, right? So the actuary will always update it based on what the conditions are. So as long as you're paying your ADC, we should be okay.
And as long as you have good investment advisors for your brain,
Yep.
and
all your expenses.
Yeah, good.
But if you sub earn, then it creates greatly amplifies.
And I assume that you won't wait 2 years to come back if it looks like you need to change strategies.
Absolutely. And we'll like I mentioned, the next meeting in March, we'll have the new valuation. Let's see how we do then.
Thank you so much. Any other questions for Alice or
Just a couple.
you have something else you want to tell us?
Yeah. So that was just a snapshot of what the activities of the trust. So the 3 things that we do need to do real quick is one, the review the OPEB investment policy and the charter. They're included here. Staff has a recommendation to make any of those changes for those 2. And the last thing is to review the trust board service providers. So that's really 2. That's PFM as well as U.S. Bank as the trustee and custodian. So just to do quickly, if you turn to page 3 in the middle of the page, you'll see another graph. And this just shows in a snapshot kind of like in terms of performance. I'm showing the 1 year, the 3 year, 5 year, 10 year, and since inception. The first row is what I'm calling the gross return, and that's what Andrew always shows. It shows the gross return, the investment return from the investment managers, but it's before PFM's advisory and U.S. Bank's fees, but it's gross of the net, the investment manager fees. So you see that for instance, the 11.56 for the 1 year, 11.2 for the 3 year, and so forth. And then I'm deducting from there the PFM and U.S. Bank trustee fees to get to a net return. And I wanted to compare that to the CRBT because that's where the trust could have chosen not to create our own trust. We could have gone with CalPERS CRBT. And you can see that in all timelines except for the 1 year, PFM has beat them. And note that this is even after PFM's fees of anywhere between 18 to 22 basis points compared to, and I think CRBT's is like I think 0.085. basis points. So it's much cheaper to go with CRBT, but as you can see, the performance of our reinsurer with PFM still beats it in most cases.
My dad used to say what the competition sells is cheap. What we sell is inexpensive. Yep. So they're less expensive.
But we get the net good performance. We can make money off of it. And then we talk about pricing as another area that you evaluate them on. And I won't spend too much time on their contract because, as you guys know from the previous meeting, is that we negotiated a lower contract for starting in 2026. But I want to just recap during 24-25 the expenses that were paid out of the trust for PFM and the investment managers, and that's in that box, it's in that grid in the middle. We paid PFM about $222,000. That's 0.16% of the market value assets. U.S. Bank's another $32,000 for a total of about $254,000. And then on top of that, what's netted out of our investment returns is $467,000. That's the estimated asset managers' fees and expense ratios. And the last thing I wanted to point out, which is customer service, PFM and U.S. Bank's OPEB business is $7.8 billion, servicing 66 public agencies. Their transportation clients include LA County Metro Transit as well as MTC, and you'll see some cities and counties listed there as well. But overall, staff have been very, very happy with PFM and U.S. Bank's customer service. They're always there to answer our questions. If had any issues or inquiries, they respond immediately, so I really appreciate that. And the last thing I want to point out, here's a summary of the new contract, and I've spelled it out in the middle of page 5. And notable is that at the point of PFM fees, they added the new brick. So after over 300 million, it'll be 0.05%, where in the past it was at 0.10%. And U.S. Bank, they reduced their first 500 million assets from 0.02%, to 2.02% from 2.5%. So that's very helpful. And they also added 0.002% as additional tier over 200 million. So that saves it's estimated to save us about $50,000 during the course of the contract. Okay, so the last thing is that you'll see the attachment. This is a draft of the report from the trust board to the district board. It basically just recaps what I reviewed with you just now. I want you to have your attention to go to page 3 towards the bottom where it's italicized. So I've drafted in here as just a placeholder of what we've written in the past. So I wanted to see if that's okay to repeat that for the report to the district board, or if you'd like us to add anything.
Would you take a look at that wording, or just tell me what you think about keeping it the same versus trying to make some changes? It basically is review and reassess the adequacy of the trust board charter and recommend proposed changes, if any, to the board tomorrow. Any comments on that one? Okay, hearing none, do we need a vote on that?
You do.
All right, could I have a motion to please accept that recommendation?
So moved. Second.
Would you call roll, please?
Dr. Cochran?
Yes.
Devlin?
Aye.
Giudice?
Yes.
Hernandez?
Aye.
Maston?
Aye.
Rodoni?
Aye.
Vice Chair Park?
Aye.
Chair Rabbit's absent. Thank you very much. That's a vote.
All right, thank you. And I'd like to thank Alice.
Yeah.
Alice, we talked this morning about our employees doing heavy lifting. And I think when we go through this trust information, I know that you have a staff that helps with that. But I called yesterday to see if I needed to talk to you. And Jennifer said, oh no, Alice has it under control. And you clearly do. And that's heavy lifting. This is a big deal.
For the record, Alice is a staff of 1. So Alice actually does it all.
She does a darn good job. Thank you from all of us.
Thank you.
For allowing us to watch you and to have the trust in you that we do.
Means a lot. Thank you.
Good. Well, we appreciate it. All right. I think that concludes our discussion. Matt? Well, we voted before the public got to. Were there any?
We have no public comment. We have no public comments for this meeting at all.
Oh, perfect. Okay, perfect. All right, thank you. I think we reached the end of the agenda. May I have a motion to adjourn the meeting? And thank you to all of you for being here. And do we need to tell him?
We just need to note that the next meeting of this group will be March 26th, 2026.
There you go.
Okay.
You can also leave these binders and record collect these.
Yeah, just leave those binders behind. We'll
All right.
collect them. The policies in here as well as the charter. That's
And Andrew, we agreed to take your service to the board tomorrow as is.
Thank you. Thank you
You're
very
welcome.
much. I appreciate
You're
that.
welcome. All right, with that, we reached the end of the agenda. The next meeting, that was March 26th. May I have a motion to adjourn?
So moved.
May I have a second?
Second.
Hearing no objections, that concludes the meeting of the OPEB Investment Trust Board. Thank you, colleagues. The time is 1:10.